They didn't announce it. They didn't warn anyone. China's biggest banks just shifted billions out of the dollar before sunrise, and the first people to notice weren't politicians. They were currency dealers who watched liquidity vanish from markets that never sleep. At that same hour, inside a secure room in Washington, officials were signing off on the next phase of a plan that carves financial value out of Russia's frozen reserves, a move Reuters says could rewrite how sovereign wealth is treated in a crisis. The two events weren't designed to collide, but they did. Violently. By the time Europe opened, one fact was rippling across every major trading desk. If China is dismantling its dollar exposure while the United States expands control over foreign-held assets, the global financial order isn't drifting. It's snapping. Across the Pacific, United States officials were finalizing the framework that Reuters said would govern the handling of Russia's frozen reserves, a $300 billion pool immobilized across G7 jurisdictions since the invasion of Ukraine. The latest Wall Street Journal reporting showed that Washington was preparing to route interest income generated by these assets toward long-term support for Ukraine's reconstruction. What had been a slow diplomatic process was now becoming a permanent financial mechanism. And, well, markets instantly recognized that permanent mechanisms trigger permanent reactions. What made the timing explosive was how the two stories collided. The Financial Times confirmed earlier this year that the European Union had already begun diverting income from Russia's assets into Ukraine-related funding. When the United States entered the equation more aggressively, the narrative shifted. A legal tool initially used as wartime leverage was quietly turning into a pillar of Western financial strategy. For reserve-heavy countries, that shift was not an abstract concern. Bloomberg's October coverage noted that China, still the world's largest economy and a top holder of United States debt, had been reducing exposure for over a decade. But, this latest policy development added a new, unpredictable variable. The first market consequence landed where it always starts, the offshore Yuan market. Reuters observed that liquidity tightened sharply as Chinese commercial banks increased overseas renminbi lending, redirecting borrowers away from dollar credit lines. Lower Chinese benchmark rates made those renminbi loans attractive, but borrowers were forced to confront what it meant when the world's largest exporter was deliberately shaping global credit through its own currency. Instead of waiting for dollar markets to respond, Beijing was making the adjustment itself. The tension grew when the Financial Times revealed that Chinese banks had nearly quadrupled their overseas renminbi assets in just 4 years, an expansion with no historical precedent in China's outbound financial strategy. While the dollar still dominated global payment systems, SWIFT data showed the renminbi breaking into the top 5 currencies for global transactions. Even if the share remained small, the direction was clear enough that bond strategists in Singapore began recalibrating their risk models on the fly. Inside Washington, the debate over Russia's immobilized reserves intensified. The Wall Street Journal reported that several emerging market governments privately questioned whether sovereign wealth stored in Western jurisdictions could be considered fully insulated from geopolitical conflict. American officials insisted the Russian case was unique, grounded in international law and wartime aggression. Yet the question lingered if sovereignty over reserves could be reinterpreted once, could it be reinterpreted again under future conditions? That question was amplified by central bank behavior. According to IMF data compiled by the World Gold Council, global gold purchases reached their highest levels in more than half a century, with China accounting for one of the most consistent periods of accumulation on record. Bloomberg noted that the People's Bank of China had increased its gold holdings month after month before briefly pausing, but analysts widely interpreted the pause as tactical rather than a change in direction. Gold moves silently but speaks loudly, and every ton added to reserves widened the gap between China's official rhetoric and its financial preparations. By the time European markets opened, another round of Treasury sales appeared. Dealers told Reuters that Chinese-linked entities had also begun trimming agency debt, traditionally considered among the safest assets in the global system. The selling was not frantic. It was organized, spaced, deliberate. But, deliberate selling is actually more unsettling than panic. Panic fades. Deliberate behavior becomes the new baseline. In Brussels, the European Commission confirmed it was expanding the framework for managing proceeds generated from frozen Russian reserves. The Financial Times said officials were analyzing whether additional streams of income could legally be diverted toward Ukraine. For markets, the legal details mattered less than the directional signal. The G7 was building a precedent that connected geopolitics directly to reserve management, and China was maneuvering before that precedent hardened. The contradiction deepened when Bloomberg reported that China's regulators had instructed banks to curb short-term dollar funding, which had ballooned when United States rates were low. Now, with United States rates above 4%, those funding channels became expensive liabilities. Chinese institutions were shifting not just for political reasons, but economic ones. De-dollarization was aligning with cost advantages, making the shift both ideological and profitable. Energy markets produced the next shock. You see, China had already become the dominant buyer of Russian oil after sanctions reshaped Moscow's access to Western markets. The Financial Times reported that a growing portion of that trade was settled in yuan, which, undermined the dollar's long-established grip on commodity settlement. Renminbi settlements didn't simply reflect political loyalty. They reshaped how Chinese banks accumulated and deployed currency abroad. Inside the U.S. Treasury building, analysts tracking the Russian reserves recognized the feedback effect. Every step the G7 took to harden the asset seizure framework pushed reserve-heavy nations toward diversification. It wasn't a sprint, but rather a steady walk. The New York Times confirmed that European policymakers had begun drafting long-term plans for sustainably managing the Russian assets over multiple years, which signaled permanence. And, permanence forces recalculation. China's recalculation was visible in its commercial banks. Treasury's official TIC data showed China's holdings declining steadily, but the deeper shift was occurring off-balance sheet through new lending channels, currency swap lines, and renminbi settlements. Reuters noted that several emerging market central banks activated Chinese swap lines during recent global funding squeezes, demonstrating the practical value of having access to yuan liquidity when dollar markets tightened. The midpoint came when the Wall Street Journal published data showing the sheer volume of Chinese bank assets denominated in renminbi overseas, levels, honestly, no one in Washington anticipated a decade ago. This revelation carried a tonal shift. Beijing was no longer experimenting with currency internationalization. It was building a parallel credit ecosystem, not large enough to challenge the dollar today, but certainly large enough to reduce dependency among China's closest trade partners. That shift reframed the entire conversation around Russia's reserves. Washington viewed the asset seizure mechanism as a narrow, war-linked tool. Meanwhile, Beijing saw it as a preview of what financial power looks like when geopolitical red lines shift. Even nations with cordial ties to Washington began internal reviews of their reserve strategy. Reuters said finance ministries across Asia, the Middle East, and parts of Latin America were studying whether their reserve concentration created long-term exposure they could no longer ignore. Gold markets delivered another signal. Bloomberg reported that while China's official gold buying paused, unofficial channels continued acquiring metal through state-linked institutions. Diversification wasn't symbolic, it was measurable. Each purchase reinforced the reality that Beijing was moving pieces quietly while Western powers moved theirs loudly. On Wall Street, the dollar still appeared unshakable. IMF COFR data showed the dollar holding roughly 59% of disclosed global reserves, far ahead of the euro and miles above the renminbi. But the stability of the headline masked instability beneath it. The share was stable only because smaller countries maintained holdings, even as the largest holders trimmed theirs. Global reserve composition wasn't shifting evenly, it was shifting at the top. By afternoon in New York, currency strategists were analyzing a new layer of risk. If China's commercial banks continued reducing dollar exposure while Beijing accumulated gold and expanded renminbi lending, how long before other major economies followed for reasons unrelated to politics, simply to reduce vulnerability to sudden policy shifts? U.S. officials finalizing the Russian asset framework saw none of this as an attack on the dollar. They saw it as a necessary instrument in a conflict reshaping Europe. Chinese bankers reducing dollar exposure saw none of it as retaliation. They saw it as insulation. Yet the two forces interacted regardless of intent. The United States was increasing the tools it used to enforce geopolitical outcomes. China was increasing the buffers it built against those tools. As markets closed, Reuters carried a quiet but telling line. Several emerging economy governments had begun discussing adjustments to long-term reserve strategy with external advisors. They weren't planning to dump dollars. They were planning for a future in which the consequences of geopolitical alignment touched the balance sheet. Chinese banks were already living in that future. U.S. policymakers managing the Russian assets were shaping it, and the rest of the world was watching a system no longer anchored by certainty but by momentum. No single headline captured the day's meaning, but together, the signals formed the unresolved question that now sits beneath every Treasury auction, every renminbi loan, every gold purchase, and every G7 sanction decision. If the world's largest economy keeps reducing its exposure to U.S. assets, while the United States expands the tools it uses to shape geopolitical outcomes, which force breaks first? America's leverage or the world's faith that leverage will never be used against them? Please like and subscribe. Leave your thoughts in the comments. Your support helps us grow. Thank you.